Welcome to the webinar. We'll get started shortly. Before we begin, here's how to earn CPE credit. Unlike traditional CPE webinars, there are no polling questions or attendance checks during the presentation. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz in the Earmark app. Search for the free Earmark app from the App Store or Google Play Store, or scan the QR code on the screen. Open the app and create an account. Be sure to use a valid email address because we'll email you your CPE certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. If you don't see the quiz yet, don't worry. We'll email you when the quiz is available. Complete the quiz to earn your CPE certificate. If you have questions or need help, email us anytime at support@earmarkcpe.com. Now, on to the webinar.
Hello and welcome to today's webinar, Maximizing Wealth Transfer via Estate Tax Optimization for Business Owners. I'm Joel from the Earmark team. If you have any questions or concerns, please put them in the comments. I'll be in that and checking it. Other than that, I will turn it over to Anthony for our webinar today.
Thanks so much, Joel. Happy to be here with everyone. Happy to be talking about what's a very important topic and a very germane one in today's planning environment. Really excited to get in here and hopefully find some opportunities to help practitioners listening as well as help clients kind of address these issues. A little background on me. I'm with DeJoy & Co. We're a full-service CPA firm up in Rochester, New York. I'm the director of the valuation advisory practice. I like to think that I exist in the business transition, ownership transition realm, right? That includes this as well as other things like buy-sell agreements, mergers and acquisition evaluation, those types of issues. But really focused today on estate planning opportunities. I have some niches in carried interest, complex equity structures, and family limited partnerships. Today, we're not going to focus on those necessarily specifically, but talk more broadly about planning opportunities, working with family businesses and helping them manage that ownership transition from generation to generation in a tax efficient manner. Really important topic, kind of to me, the nexus of estate planning and valuation, really a summary of my career to date. I spent the early years of my career in tax at PwC. I was with a large national valuation practice and now running one of my own. So really excited to talk about this with all you guys here today. I like to start by defining what are our goals. What's our North Star? What are we pointing at? I always say as CPAs, we exist to help clients establish and preserve their legacy. My work is a lot on the preservation side of it, but really focused on maximizing that wealth transfer generation over generation, focused on efficient and effective gifting techniques, transfer strategies, vehicles, and really setting up that next generation for success after the transfer, right? Focusing on education, other opportunities. We have a lot of barriers to execution in this realm. Bickering and disagreement are always an issue when you do with families. I feel like I'm more of a therapist some days than an accountant. That's often created by a lack of understanding, lack of communication. So focused on facilitating those conversations with clients and their families to help smooth that process, putting in proper agreements that can help us facilitate that. We're also pinned up against tough tax structures, right? Income tax gets a lot of talk, but I think the gift and estate tax is very relevant, certainly for all business owners, but high net worth business owners especially, as we're going to get into some of the numbers involved there. So focused on mitigating risk around those and optimizing that tax strategy. The first step here to me is to go back to basics, right? Let's start at the base level of how the gift and estate tax works. Then we're going to talk through the basics of valuation and find opportunities. So this is focused strictly on U.S. federal gift and estate tax. I think something like a dozen states have their own state estate tax. Mine does. New York State has one as well. So any of these strategies would typically benefit would benefit both the state and federal side, but we're going to focus on the federal side today. So thinking about the variables at play, we have our lifetime gifts in the state, less our exemption amount, times the tax rate, and that equals our gift and estate tax. So going through one by one through those variables, our lifetime gift in the state is highly variable, highly dynamic. We're going to get into that more in a minute, But the important thing to note here is we control the split of what's a gift and what's in the estate. The exemption level, this is a really, really important topic right now. That's currently $13.6 million for an individual. And with portability, that's $27 million effectively for a married couple. It should be noted that these adjust annually for inflation. So it went up from 12 million to 13 million year over year in 2024. These were elevated to historic high levels due to the act formerly known as the Tax Cuts and Job Act. We expect this to be around $7 million and $14 million starting January 26, barring any action from Congress, which I personally wouldn't bet on. And the IRS has made it clear that these gifts made prior to that exemption drop won't be subject to a clawback, meaning if I gifted, if I was an individual and I gifted $13 million today, but I died after 2026 when the exemption was lower, I wouldn't be subject to an additional tax on that delta between the change in exemption levels. And then our last piece is the tax rate, very static, 40%. There's no expectation of change there. So how do we focus and plan around those? So business valuation is really just the confluence of risk, time, and cash flows. That's all that goes into it. I have up here that the definition of fair market value, that's what we're going to focus on today. That's defined in the code. The important words to note there are willing buyer and willing seller. Value is in constant flux. You can go look at any stock ticker and watch it change by the second. The same is true for private businesses, maybe not as rapidly, but certainly changing all the time. We have three primary approaches. We have our income approach. Maybe you're familiar with the DCF method, discounted cash flow method. That's a subset of the income approach. So we have our approaches, and those break down further into methods. The market approach, think maybe multiples, EBITDA multiples, revenue multiples, and then the asset approach. The most important thing to note about valuation is much like a balance sheet, it's a point in time, right? We're talking about a spot estimate at a point in time that we conclude our fair market value. And that's really important to note for a planning opportunity. So why should we focus on transferring business interests? Why would we do that over transferring cash or some other less important security? So there's a couple differences here. We have four tangible benefits in order being appreciation, a very significant one. Debt reduction can also play a role. Minority discounts are very important as well. And we're going to talk about that concept in valuation and what that means. And then we have a unique fact planning opportunity right now with our user loser exemption, right? That decrease from 13.6 million down to $7 million is a one-time planning opportunity. The rest of these are perennial fact patterns. So in the spirit of this, we're focused on transferring business interests at a point in time and reaping the benefits of that. So when we go back to that lifetime gifts in estate, remember we said we control the split of what's in a gift and what's in estate, right? So our estate is going to be valued at the date of death. So a point in time at the date of death, here's the value of the estate, the fair market value. Lifetime gifts are going to be valued at the date in which the gift is made. So whatever is gifted during a lifetime is going to be excluded from the estate. So any appreciation that occurs between the gift date and the date of death would go untaxed. That's where our planning opportunity comes into play. So from a pure estate tax optimization standpoint, it'd be most ideal to gift your assets, theoretically your highest potential appreciating assets, focus on those, and that creates the biggest benefit. So if we look at the chart to the right here, I've kind of mapped out two scenarios here. So under scenario one, if we didn't make any gifts and we just left it all in the estate, we'd have that orange boundary there. This is a person that's clearly done very well for themselves. They built up a ton of wealth, and that'll all be subject to estate tax when they die. On the other side, if we focus on just gifting off individual business interests of appreciating assets over the course of our lifetime, we can reduce that total taxable gift and estate to the blue marker there. So all that orange that's showing would be the delta between the two. And in terms of an actual tax amount, we're looking at about a $13 million difference. It'd be $22 million if we just focus on the estate. If we make the gifts, it would be about $9 million. So I want to think of gifts as an opportunity to lock in, preferably a low value. Debt reduction, I mean, this is an important concept here, right? So we think about the accounting equation and go back to basics. We have our assets equals our liabilities plus equity. So typically our valuations are done on an asset-based method, or maybe enterprise value or total invested capital, if you're familiar with those terms. So we'd value all assets of the company operating, subtract off liabilities, primarily our long-term debt, and that would arrive at the value of the company. So any company that deleverages over time inherently creates more value in equity over the course of a lifetime. So this can be a concept if we apply it to something like a real estate holding company, where maybe they start with an 80% loan to value. If we pay down that loan over time with no appreciation whatsoever, we've accrued a 5x benefit, going from 20% equity to 100% equity. Now, part of that and ideas with cash planning around it, but definitely an interesting idea here. Let's talk about levels of value and minority discounts. So, like I said, our primary valuation approach would be either the income approach, market approach, or asset approach. We have two primary discounts we focus on. That's discount for lack of control and discount for lack of marketability. Discount for lack of control is the fact that if I don't control a business, meaning I'm a minority interest, something less than 50% voting interest, I don't control the management of the business. So we typically can benchmark that against closed-end fund data that we have really good studies on. We also have merger stat studies that show us these opportunities. Discount for lack of control can range anywhere from 8 to 12% typically. It can be higher than that or lower than that depending on circumstances, but generally in that range. Discount for lack of marketability, or DLAM, I would call it the big brother of the two. That can be much more significant, right? So we have a couple ways to approach this. And I could talk for a full hour on this alone. We have empirical data, right? So if we think about restricted stock studies or pre-IPO studies, that would make up our empirical data, where we can observe evidence in the marketplace of these. Additionally, we can look at theoretical options, right? So we have option pricing models. If we look at something like a put option, we can confer some type of lack of marketability there. Additionally, we have discounted cash flow models that can provide a similar analysis. Really important plug here for anyone who's dealing with business valuations or reviewing them for, maybe a gift tax return you're filing for a client. This assumption is really key. It's the most scrutinized piece. I would encourage everyone to make sure that that is being done properly. Some lower level practitioners will take maybe some shortcut approaches there that don't stand up well in court. So I would encourage, there should be a two-stage model to this, because we're technically addressing two different issues in discount for lack of marketability. So anyone wants to talk more about that, I'm happy to talk your ear off, but really focus on that part if you're scrutinizing one of these, because those don't stand up well in court. I have more information available if you're interested on my article there. So what happens if we don't do estate planning? If we don't do anything at all, what happens then? Well, we end up with a more significant value on the estate tax side. We saw from strictly a pure like appreciation standpoint, right? We also have those discount for lack of control and discount for lack of marketability. So if I own 100% of my business, I'm a controlling interest holder when I die. Alternatively, I could gift off individual pieces that are minority pieces and would be available to have that discount. So that alone can be a 40% saver right there between my lack of control and lack of marketability. But over the course of a lifetime can be even greater with appreciation factored in. So let's talk through an example real quick. So if we don't do anything, and I'm a high net worth individual, but all the value of my business, or 90% of it, is tied up in a privately held business, right? So we have John Doe here. He owns 100% of ABC Co. It's valued at $20 million. Maybe some other assets outside of that. And if he passes away in 2026 or later, he's going to have a huge exposure to federal gift and estate tax, along with potential state tax as well. So an issue we run into here is where maybe we don't have liquidity, right? So all his interest is tied up in his personal business. So he doesn't really have cash sitting around for this. So that leaves a big tax bill that goes uncovered by his liquid assets. So we have one relief in the code under IRC code section 6,166. It's not a great plan A, but it can work as a plan B. It offers some relief over payment and some terms that you can then structure those payments over time. But more ideally, we could do some planning with it. So let's say that instead of John Doe just holding on to his whole business interest and passing away, let's say he's proactive and he goes out and he goes, okay, I'm going to structure minority gifts. I'm going to do planning. So he moves 90% of these interests out of his estate using minority discounts and taking advantage of that. He could accomplish all of this and reduce his total gift and estate tax bill over the course of his lifetime to around $1 million versus a $6 million tax bill without that. That's a huge saving right there. Another benefit is the fact that we don't have to have a liquidity issue at the end of it. So he's got a $1 million estate tax bill to do at the end of all this. He can cover that with his liquid assets. He doesn't have to fire sale the business. We don't have to do anything crazy. We can use business strategies as we normally would and use estate planning strategies to address those issues instead of trying to lump them together, fire selling the business, getting less than it's worth, leaving all of our heirs in a worse place. I alluded to this earlier, but we have this really unique fact pattern right now where we have a one-time planning opportunity, best planning opportunity that's ever existed in estate tax, to go ahead and use this elevated exemption level that we were given in 2017 to do planning before 2026. Now that exemption is going to cut in half in 2026, which is significant. But the IRS has opined that any gift made prior to that using that elevated exemption level wouldn't be subject to estate tax. So let's talk through an example real quick. So Susan's an unmarried individual. She makes lifetime gifts of $12 million during 2018 through 2025. So she was underneath the exemption amount when that happened. So those didn't go through with any gift tax. And then she passes away in 2026. She got $1 million left in her estate. When she passes away, the exemption level is lower, but those aren't subject to a clawback. So that excess $5 million that would normally be subject to an estate tax if she just left it in there, or with a clawback, that won't happen. So her estate would pay maybe $400,000 in estate tax and move on. All of that was huge tax savings, about $2 million. All of that goes on to the next generation. All that goes on preserving legacy, preserving the business that you worked so hard to build. So if you're an advisor and you have a client who has net worth in excess or near $7 million, I say you should be planning with them or you're not doing your job properly. So we have all these reasons for why we should plan, but how do we actually go ahead and do that? So we're going to talk through a couple techniques, a couple alternative techniques, and how those can be applied. So we'll talk on specific trust structures and what we see a lot of. It's certainly not an exhaustive list, but can give you an idea for starting a conversation. We have family limited partnerships or LLCs. Those are a good topic as well. We have buy-sell agreements, which can also accomplish this, but there are some things to be aware of in that realm, especially in light of some recent court cases. We can use life insurance, right? So if we talk about that example of John Doe again, he could go out and get a whole life or term life policy that would cover part of that. I think life insurance is not a panacea, but can be a great solution in an overall strategy. Certainly if we're talking about even higher net worth individuals, we're talking $100 million plus of net worth. These strategies would probably be incorporated along with traditional estate planning tactics. And we can also talk about charitable gifting as well. When we talk about legacy, I don't want to focus strictly on dollars moving over to the next generation, but accomplishing the goals of the business owners and the clients. Or more simply, we don't even have to use any of those. We can just transfer interest directly. That tends to work well with smaller businesses. To the extent that there's not a massive benefit accrued by using one of these techniques, a direct transfer is a perfectly fine option. The estate planning overall is key to success. This is part of it, but we need to consider other factors as well. It's always good to engage a good attorney to help with this. You want to have a client have a will, power of attorney, healthcare proxy, et cetera, all those documents in place. Regardless of the estate tax issue, those things need to be in place before we start talking about those estate tax issues. It's important to get updates regularly, right? Going through here, checking your beneficiary designations on 401ks, life insurance policies. And I would say engage a good T&E lawyer. If you pay $250 online to have somebody do it, you're going to get what you paid for. So trust structures. So we have a couple that I see pretty commonly and to me work really well in today's planning environment. We have our IDGETs, intentionally defective grantor trusts. So these are really useful to move assets out of a taxable estate. You'll still incur a gift tax on the transfer, assuming you've used your exemption, but it creates benefits that we previously talked about. The grantor, or the gifter, I like to say, would continue to pay the income tax on that trust until they hit the off switch. So think of it this way: if not only are we transferring over our gift, but then we're paying tax, right? So that's moving more cash out of our estate and then accruing benefit to the next generation. All that tax payments would not be subject to our exemption levels, meaning that we can functionally leverage our gift even further than the items I talked about regarding, right, appreciation, minority discounts, et cetera. We're already accruing additional benefit on top of that, right? Really good opportunity for certain individuals. So it's intentionally defective, right? Meaning that it can be defected. So there's functionally an off switch in there where we can turn the giftee into making them liable for the income tax, right? That can't be switched back, but maybe for individuals who have younger children or maybe young working adults that they're gifting to that can't afford the income tax bill for now, we can do that over time and then switch it over once they got to the point where they can support that on their own. Great for business owners that don't want to feel like they give control. That's always a tough conversation to say, hey, I think you should give this over to your kid. The business owner is like, oh, I run this place. This is mine. We don't have to give up control. This can happen regardless of that. We can do all this planning opportunity without giving up control. So important to assuage them of those concerns there. Important to be aware of family relationships overall, right? We don't want to give this to somebody who is a son that's going to be disowned or a daughter that's going to be disowned, right? That thing is irreversible. So be careful when you're advising clients on this. Always good to talk to a lawyer as well. We have a spousal lifetime access trust, or a SLAT. Really good for use or lose it during the pre-2026 transfers. Functionally, it's a left pocket, right pocket for most people. If you have a good relationship with your spouse, you're not concerned about that over time, this can be a great solution. We can even do a pair of slats, one between the husband and the wife, and one between the wife and the husband. Important when you're structuring those that those don't look identical, because the IRS will look through that and just pierce right through them, but can still accomplish a lot of benefits. So that's one I would absolutely encourage you to talk at length with a lawyer before you pursue that. We have a couple other options too. GRATs are a great one. Grantor retained annuity trusts. Those are more ideal in high rate environments, those are more ideal in low rate environments than high rate environments. So I don't typically suggest clients do it now, although I have seen use cases today still where it makes a lot of sense. And we're going to talk through charitable trust structures as well. Function similar to these, but accomplish a charitable goal as the beneficiary rather than a family member. So family limited partnerships are an interesting concept and one that probably usually gets reserved for ultra high net worth individuals, but in my opinion is applicable to anyone who has maybe even 10 or $20 million of net worth. These can accomplish a lot of that goal, especially if there's a core family business in play as well. What I like about flips and flicks is that they're a great succession planning tool that can also benefit heavily from estate planning. The most beneficial part of that is that we take those two timelines off each other. So we take what would traditionally be our succession and estate planning timeline together and cut it apart into two separate timelines. We can plan for succession when succession is ready, and we can plan for estate tax when estate tax is ready. Authenticity is key in these. I always say this, we have to live to the letter of the agreement. So if you're putting this in place, clients need to be holding board meetings. They need to be taking care of financials. They need to be doing all the paperwork properly. If you made a transfer, you need to really affect that transfer. If we don't do that, then there's significant risk on the IRS side, and they've been heavy-handed in those cases. So make sure if any client is doing this, they're living authentically. But what it does is it functionally creates a business that didn't otherwise exist. So when we think about that, if we talk about our minority discounts we mentioned earlier, maybe I have a large portfolio of marketable securities, maybe $50 million. I can put that into a family limited partnership, and then you make that a contribution, and then I would get all of the GP and LP interest in a flip, and then over time I can gift out specific LP interest to my children or trust for my children's benefit. Why that works really well is now we create a business structure where we can access DLOC and DLOM that otherwise wasn't there or available before, functionally just creating a restrictive barrier that we then have to work through on evaluation and gift and estate tax side. Really suitable for really anyone, but works really well maybe for high earning executives and publicly traded companies who are being compensated with stock. Can also hold a private business, so I can contribute my private business to that. I retain the GP interest, right? So we're talking about giving up control as a business owner. I would always retain my GP interest, but I could gift off 99% of my value through LP interest. I haven't given up any control. And then when I'm ready to succession plan, right, we're having these quarterly board meetings. I'm meeting with all my family members. We're talking about all these things, right? I can get them educated up to speed. When I feel comfortable, I can gift off that final GP interest to them, or I could even just leave that in my estate. And I probably don't have a ton of exposure on that relative to the 99% of value I was able to transfer over without that. So I always plug and say, this is not just for the ultra wealthy. I know that usually only billionaires have these, but these strategies apply down the line, and the compliance cost isn't huge. And I love the fact that we can benefit by splitting a succession and estate planning under their own dedicated timelines. Yeah. Buy-sell agreements are an awesome tool as well, right? So we create a tool to functionally facilitate that succession planning. Works well for family-owned businesses, but also works even better for non-family-owned businesses. So maybe I'm a business owner and I don't have any children coming up in the business, but I have 2 or 3, upcoming executives who've been with me for a long time that I feel comfortable could step up in that role. So instead of doing that as a gift, I could do it as a sale through a buy-sell agreement. We can do this in combination with gifting strategies too. Another point to make, that just because I want to have the next generation buy in, maybe I feel that way about my children. I want them to pay money. I paid money for my business. They should pay money for it too. I can do it hybrid with gifting strategies. So I could have a buy-sell agreement where I sell them 10% of the company for a fair market value, and I also make a gift for that same fair market value to them, right? So I can scale up based on liquidity needs. That's managing parent liquidity needs and children liquidity needs, which is what I like about it. Parents don't need to feel like they gave it all away. Children can feel some ownership that they paid for it, but we don't create any tax burdens anywhere that are undue or unneeded. Really good to use in tandem with life insurance policies too. That's where I think I've typically seen these used. Important to think about this not only from a corporate perspective, but an individual perspective. And we're going to talk about that more on the next slide. One pitfall I can see in these a lot of the time is that there's a very strict valuation formula. And as somebody who works in business valuation, I can tell you it rarely reflects fair market value. So I prefer to put guardrails on it rather than saying specific, cadence of value in a formula. That tends to work better, in my opinion. The best practice would be to get annual valuation updates, use that number of fair market value for the whole year. It works also really well because now everyone's informed on what the value of the business is, right? So we can see our benefit of our hard work matriculate over time, not just on our balance sheet or our income statement. We can see it in a hard valuation number. It establishes a really good understanding overall of stakeholders of what the value of the company is and how that works. And it allows for swift execution in the event that somebody dies. I had a client, worked with him for 5+ years. Major stockholder died suddenly. That would normally be a huge deal and a big problem. They were probably a $100 million company. But they had a buy-sell agreement that they were regularly using on an updated basis. So they were able to transfer over a lot of those interests before he died, but not all of them. But then we have a really clear paradigm for buying him out, right? There's no surprises when that bill came due. All the parties are ready. Everyone just followed in lockstep. We wrapped up that $100 million estate in 3 months. That's just unheard of. So it shows the difference that good planning can do in making that process easier, especially in a time when people are grieving, struggling. The business is probably struggling, losing a major player in the activities of the business. We can help kind of alleviate that issue with good planning. So I kind of set this issue up earlier when I talked about life insurance. So it's a very specialized tool. It works very good for a specific problem. No tool is good or bad. A hammer's not good or bad. It just matters how you use it. It's not a panacea. It's not going to solve all your problems, but it can work really well in tandem with some of the other strategies. A real benefit of it that it provides liquidity for either the company or other shareholders to purchase the stock of a deceased shareholder. That's what I really like to see it used for. There's a couple different structuring options here. Really important to really think through these and the consequences of them from an income and gift and estate tax perspective. So we could have owner-held policies, right? So let's say we have a company with two 50-50 owners. We can then have them individually own policies on each other, right? Whether that's term or whole life. And then that funds coming from the life insurance proceeds would then be used to buy out the deceased shareholder. We can also have company held policies. So we would have the company as a beneficiary of one of these policies, and then they would just repurchase those shares into treasury, functionally making all the outstanding stockholders whole for the 100%, right? So that could be applied to in that 50-50 shareholder scenario. That could be held as well. And then we also have LLC held policies, right? So we could establish a separate limited liability company to hold these policies and do nothing else. And that would then have the same ownership structure as the primary company and would be the beneficiary of those policies. So if anyone died, the LLC could then buy the interest out, make a distribution of shares out to an individual owner and accomplish it that way, or continue to hold the actual operating company business in the LLC. These are not key man life insurance policies. These should be separate from that. This is not going to address your downturn that comes from a major player in your business passing away. These are really for the purpose of redeeming shares. One thing to note here, there is a court case before the Supreme Court right now. That's Connolly versus United States. Issue there is that the company held life insurance policies on both of its owners. One owner passed away and then it redeemed them out. In Connolly, the IRS has prescribed and actually won in the lower level courts to say that the value of the life insurance proceeds should be included in the valuation of the company. There were some mistakes on practitioners from the valuation side and from the legal side that I think created this problem. I don't think this isn't necessarily a guaranteed issue, but important to learn from that. We'll probably have an answer from the Supreme Court on how that should be handled in the next maybe couple months. But important to watch that case if you're having any clients that have this similar structure set up, to really learn from that and go back and benefit from there. Because that is creating a massive estate tax bill that really was supposed to be the solution. Now is creating a bigger problem. So important to kind of think through some of those issues as we're dealing with that. So when we talk about legacy, like I said, I don't want to just focus on money. It's not just about money going down to the next generation. It's about establishing your legacy and what you want to do with it and what you want to be remembered for. So we have a couple different trust structures available under the code that can help benefit from these. We have charitable remainder trust, right? So the way that works is it'll pay income to a beneficiary. That would be a charity. An income to a beneficiary that would be a child or dependent family member. And the remainder of that would then go to charity. So over the lifetime of the CRT, all the income goes back to the beneficiary, and at the end of that policy, at the end of the trust life, the remainder would go over to charity. We have charitable lead trust, CLT. That's kind of a mirror image of a CRT, right? In the interim time from establishment of the trust through the end of the term of the trust, all income would go to the charity, and then the remainder would go to the beneficiary. So just a mirror income there. We have a charitable remainder unitary trust, a CRUT for short. That pays income to the beneficiary, right, our child, based on a fixed income percentage, and then the remainder goes to charity. So typically that would be set up to, I don't know, maybe 8 or 10%, and that would be paid out over the lifetime of the trust, and then the remainder would go to charity. We have a NIM CRUT, which is kind of like a hybrid between a CRT and a CRUT. So what I like about this is it pays the lesser of a fixed income percentage or the income of the actual business, and the income of the actual trust, with an opportunity to make up that fixed percentage later. These work really well and are really ideal for a lot of clients. So I would encourage you to look at this. Charitable lead annuity trust, or a CLAT, right? This is very similar to that, but kind of the same way that a CLT was a mirror of a CRT. We have the same thing here with the CLAT relative to the NIM CRUT. So same case here where income is going out based on a fixed percentage to a charity now instead of a beneficiary, and the remainder goes to the beneficiary. The valuations prescribed in those are largely based upon statutory rates that come from the IRS. So if you're ever dealing with that, you can go there. I would also encourage you to engage a qualified appraiser to opine on that as well, because there are nuances there that kind of get grafted over when we don't actually engage somebody who's specialized in this. All these trust structures are going to end up creating two things, right? They're going to create a gift tax filing, right? Because we're making a gift to our beneficiary, and that would be recognized usually at the start of the trust. And then immediate charitable deduction. So important thing when we're planning here that we're thinking about income tax planning as well as gift and estate. So I'm talking a lot about gift and estate tax, but also important to not ignore income tax issues that come up through this process. Same thing that I would say if we're planning with real estate that has a large built-in gain, right? Think about how that's going to affect on the income side and what benefits we can get using gift or estate tax. There's a couple other strategies we can do as well. Testamentary charitable gifts, if you're familiar with these, right? We can say that in my taxable estate, all assets remaining would go to a charity. Additionally, we could also do it to a fixed dollar amount. So sometimes you'll see those written to the federal exemption level saying, okay, if I pass away, any of my net worth in excess of $13.6 million will go to this charity. And that would then avoid the estate tax issue. And that has held up well in court. For higher net worth clients, maybe they want to explore something like a DAF, a donor advised fund. This is where the individual would make contributions to a DAF, right? Those would not result in any charitable deduction. They would receive a deduction there. And then they make gifts over time to charity out of that. That can be a really good planning tool. Maybe if you ever heard the concept too, that instead of making, one charitable gift in a single year where it's not, getting me on schedule A over my my standard deduction, we could think about the idea of piling up gifts. So I'm not going to make any gifts for 5 years. And in the 5th year, I'm going to make a big gift to charity, right? Storing all that money up. And then I'm going to actually realize an income tax benefit for. That same planning strategy applies to these as well. And then a family foundation, which is really just a more complicated version of a DAF. It helps the foundation retain control, but is subject to very, very strict rules. And there's definitely some administrative burden that goes in there. I would recommend them those only for ultra high net worth individuals, folks who are ready to establish and make this the focus of their life. For other clients, there are other strategies like the testamentary charitable gifts or, storing up our gifts and making a big gift in a single year. There are other strategies that can be at play and make a lot of benefit as well. It's really important to evaluate these across the individual. I appreciate everyone taking the time today. I'm always happy to talk about these topics in more detail. I kind of grafted over some of them, not to get overly into it, but just deliver the message. But we could dive deeper on all these topics and get deep into detail about how they can work. So going over some of the questions we have coming through in the chat, and I have my contact information here. If you ever want to reach out, I'm happy to talk. I'm a regular poster on LinkedIn, including my newsletter that's published monthly. So if you're ever interested in getting more information from me, I'm always regular on there. So we have a question. Joel, can you throw that up on the screen? Thank you. So elaborating on the benefits and potential risk of a family limited partnership and estate planning. So the real benefit there, I think, is divorcing our two timelines, right? Taking our estate timeline on one track, taking our succession planning on another. We can also functionally create some benefit there when we talk about creating an entity that wasn't there before that creates minority discounts. There's definitely risks to this, right? I think the risks are not being genuine in how you approach it, right? The idea is I'm going to do this and I'm just going to save 40% of my tax bill. I can tell you it doesn't hold up in court. It gets shot down pretty quickly. Important to work on this in a very authentic way, right? Go through this, do this the right way, live the credence. It really needs to be an overall strategy taken on by a whole family, right? That's why it's a family limited partnership. You guys all need to buy in, be willing to walk the walk and talk the talk. So that can work out well. But when those aren't done authentically, these gifts get pierced through when it looks at the court, and they're subject to a big tax as well as penalties and interest potentially. Can you throw that one up, Joel? That just came in. Thank you. So the user-loser exemption. So I think maybe take a step back. There's no exemptions set in the code. We're just looking at the unified credit, which connects the gift and estate tax and grossing that up into a net worth value. So it's really specifically aimed at today's issues, right? So we always plan around exemption levels, but we don't usually have the problem where the exemption is going to go down, right? Like I said earlier, it's increased every year for inflation adjustments. So in this way, we kind of have a one-time planning opportunity. So I always say for any individual who has, north of $7 million, they should be planning about the idea of what does a gift look like for me, and can I benefit from this one-time exemption? Even if I'm way in excess of that, if I have $100 million, I should just gift above my current, or up to my current exemption level, use that benefit, because I'm going to lose it starting in 2026. So important when we're looking at the gifts over the course of our lifetime, and something that I think is going to make me very busy over the next 2 years, is how do we utilize that exemption? I know some individuals are sitting back and waiting to see if there's action from Congress. I personally don't think they could agree on a pizza order together, so I wouldn't assume any legislation's coming down there, even headed into election. But something to be aware of, that this is a very specific planning opportunity we have today, and the clock is ticking. Anyone looking to get this done, don't be making calls in fall 2026, because people aren't going to answer. Start planning for it today. Focus on making gifts as soon as possible. You can make a gift in 25 and 26 and still get a benefit for it. But now we're really under the gun. So move fast with these and make your decision quickly. Oh, we have one more question come in. Joel, can you throw that up? Thank you. So talking about our goals of estate tax optimization, it really, to me, is just legacy preservation, which legacy can mean a lot of things. But if we think about how to manifest when we're talking about estate tax optimization, having more dollars can help us accomplish more goals, right? Whether that's generational wealth, whether that's, a charitable inclination, right? We can do all of those through estate tax planning when done properly. The barriers that often hinder it, I think, are that initial conversation, right? I see a lot of clients kind of get caught up, especially private business owners, when the first question in that first meeting is, okay, well, what's the business worth, right? Everyone goes silent and nobody answers, and then the whole thing starts to fall apart. That's why I try and inject myself into those conversations that I can, because I've been a part of those lot of conversations. I know what needs to be said next, and keep the dialogue going. Really important to start that dialogue, get the ball rolling, make sure everyone's aware of the strategy, right? Ideally, everyone buys in and approves of it. But really, communication is key, as is with everything. So being extra communicative, being very clear, engaging the right advisors. This is not a DIY project, certainly not on the estate planning or valuation side. So engage with the proper professionals to help you through that process, or help your clients through that process if you don't have all the expertise in-house. I work with tax professionals in my office. I work with lots of tax professionals outside, attorneys outside my office. So there's flexible arrangements you can figure out in a way that helps you maintain that client relationship, but get your client the best result possible. Awesome. Well, I don't have anything else, but I really appreciate everyone being here today. Happy to come talk to you. If you're ever interested in talking about anything else, just reach out and let me know. Thank you.
Thank you, Anthony, for hosting today's webinar, and thank you to all of our live attendees today. And with that, have a great rest of your day.
Today's webinar has ended. We hope you enjoyed it. To earn CPE for watching, download the free Earmark app. Scan the QR code on the screen to visit the download page. Open the app and create your account. Use a valid email address where you will receive CPE certificates. Then register for the course. You can search for it by tapping on the magnifying glass icon on the home screen and then entering the name of this webinar. If you're attending the live stream of this webinar, keep an eye out for an email letting you know when the quiz is available in the next few days. Pass the quiz to earn your CPE credits, then tap the button to email yourself a CPE certificate. Stay tuned for more webinars from Earmark. We appreciate you joining us today, and we look forward to seeing you again soon.